A few months ago, I did a video on how a couple of value investors were finding that Dollar General stock was interesting or compelling. They started buying shares. This included Tom Gaynor from Markel as well as Seth Klarman from Baupost. Baupost subsequently exited the position, but looking at the stock, it's continued to plummet. Now, over the past 3 years, Dollar General has lost over 60% of its market cap. This has been a terrible return for investors. And yet, if I put it in through AI Ticker Chat's predict feature, which it provides a hypothetical framework for how it could perform in the years ahead, it's actually suggesting that Dollar General has quite reasonable or even compelling upside in the years ahead. And so maybe, somewhere between 100 to 300% upside based on continued single-digit sales and margin improvement, and maybe a little bit of multiple expansion as well, driving arguably a very compelling return. So the question is, what's going on with Dollar General stock? Why has it been falling? And so let's look at their most recent results, try to assess, if they're facing structural challenges or it's more of a cyclical in nature. What is it that management's calling out is going on? So we're going to go through their financials along with what management has called out, thoughts on their valuation, where Dollar General can go from here, my thoughts on the business and investing more broadly. If you enjoy educational investment content, please make a point of hitting that thumbs up. Hit that subscribe button. You're watching Unrivaled Investing. So let's dive right into looking at their second quarter results. So I always prefer seeing this type of detail, what is going on. And arguably, it's sort of mixed. Consumables, which is one of the key aspects that I like about this business, because consumables means you sort of have a greater degree of recurring nature. When it's consumable, okay, you consumed it in the past week or past day, and then you're coming back the next day when your paycheck clears or when you get your benefits, and then you can go and pick it up. And when you're talking about consumables, which is the vast majority of their sales, that's food, cleaning supplies, pets, pet food, a lot of Dollar General private label items, priced around $1. Some of them are priced a bit more. But this is, you're getting a sense that these are people buying the everyday necessities. Now that grew around 7% in the most recent quarter, which does not suggest that they're losing market share. That suggests they're holding, they're doing all right. But the problem is in the more discretionary categories, seasonal, home products, apparels, that all showed contraction in the most recent quarter. And this is part of the reason why, the results have come under pressure, is because consumables are inherently lower margin versus some of the more discretionary, categories. So you're seeing gross margin dropping from 31% to under 30%. Plus you have some issues with continued theft in the stores. The code word that they use in the industry is shrink. Personally, I sort of called out in a prior video, people are going to have different values on this, but I personally view that this is sort of a societal principles problem to a degree, which is that how much shrink, how much shoplifting is tolerated by society. I personally would have a much, much harsher type of approach. Charlie Munger once commented about how some public hangings might do well for society. So, I'm not saying I'm going full public hangings, but I think, one could... society might benefit from greater shame, with some of these things. Now, it's important to have context here. And we're going to talk about the sorry state that a lot of these consumers are in just a second. But so you not only have shrinkage or shrink in the business, I was thinking about George Costanza in The Cold Water. It's shrinkage. And then you're thinking about the costs in this business, going higher, because, labor costs, inflation. So you've had this, difficult aspect looking at this business where, margins are going lower, costs are going higher. And as a result, it's really ugly in terms of their profit. You could see their earnings went from over $2 a share to $1.70. So that is one of the key reasons why the stock is going lower, even though sales has gone higher from a little under 10 billion to 10 billion in the most recent quarter, 10.2 billion. So reading what management, called out as the issues during the quarter, they talk about how their core customer, they've seen a shift in the most recent quarter and how their core customer is less confident in their financial position. Majority of their customers feel worse off financially than where they were 6 months ago. I'm curious to see how that plays out into the upcoming presidential election. And just as a side note, And, these consumers have been impacted by higher prices, softer employment levels, i.e. they're having a harder time getting a job, increased borrowing costs. And this is a really important data point when thinking about Dollar General. 60% of their sales come from households earning less than $35,000. So you're talking about a lot of people that are struggling here. 60% claiming they're sacrificing on purchasing basic necessities due to the higher costs. They talk about how 30% of their customers have at least one credit card that has reached its limit. So this is, I think looking at Dollar General and understanding this consumer base, I think if this is your first time reading about this, understanding this dynamic, it is appropriate to have some modesty and humility, reflecting on like, wow, what a fortunate position, you might be in to be able to think, hey, I'm thinking about putting capital to work. These people, when you're talking about tapping out and maxing out one credit card and then moving on to the next, you're pretty much in the end game of your own finances, because these credit cards compounded, 20, 30%, and they're not. It's extremely unlikely they're, some of these folks are probably dealing with payday loans. So this is really very tough socioeconomic perspective. And they're saying they're struggling, with basic goods. Now, consumables are picking up, but the rest of the categories, that's where they've seen the pinch. And I'd argue Dollar General here is probably from a cycle perspective, this is sort of the worst part of the cycle for them, because the lower socioeconomic have been hit. And in the past downturns, they've actually benefited, because you have the higher consumer, the higher socioeconomic, the better income earners. They would trade down, say, hey, maybe, the Whole Foods go to Ralph's, the Ralph's go to, the Albertsons, Ralph's go to Dollar General possibly. And you'd have this trade down effect that benefited some of these dollar store concepts in past cycles. You're not yet there in terms of this economic cycle where the middle and higher incomes have seen that level of pressure that the lower income households. So this is sort of, I'd argue, in terms of a cycle, closer to that max pain point, because they haven't gotten any sort of the tailwinds from the more discretionary income households. And meanwhile, the competitive environment is tough, talking about a tough promotional environment. That means competitors are, cutting their prices or having more discounts. And so that's also contributing to their sales hit and their gross margin hit. So competition, as well as sort of the cyclical challenges where they're at. And as a result, Wall Street really doesn't like it. Seeing that there's been management turnover, the CEO came back after he left, and then also seeing that they lowered their outlook, where they're saying this is the part Wall Street really doesn't like, is when you say you're going to do this and then you whiff, then it's like, okay, do you really have good control over your business? And that's, no one likes to see that. You want to be under promise and over deliver, and you're seeing them whiff both on sales, same store sales, and earnings. And so that is a real element that's going on here. So what are my thoughts about Dollar General, the business, where's the stock potentially go from here? First of all, as always, this is not financial advice. And recently, Michael, a premium member of Unrivaled Investing, commented, this is a direct quote, "So far, the subscription has paid for itself in 3 months." This follows another subscriber posting on how, another direct quote, "I've recently paid my second annual subscription and couldn't be happier. I've profited enough to cover the next 20 years of subscription." So if you're looking for compelling investment ideas, come check out Unrivaled Investing. I do expect to raise prices this fall. Looking at Dollar General, this chart shows their revenue with AI ticker chat. And it shows, by the way, we're hiring now for a head of growth at AI ticker chat. If you're interested, see the link below. So this shows that for Dollar General, sales growth really isn't that much of a problem. Yes, they might have to revise it slightly lower, but they're still growing single digits, expanding new stores, selling more, able to raise prices, and Wall Street, that's the green bars here, they're also expecting continued growth ahead. This is Wall Street, estimate average. So I'd say looking at the revenue picture, that's not the reason why the stock is down 60%. The reason why the stock's down 60% is because margins have come under pressure. And you can see how free cash flow has collapsed from, let's say, between $1.5 billion to $2.5 billion to under $1 billion. So that is the main aspect to this. And you can see how margins, the operating margins for Dollar General, historically between 8 and 10% plus, are now closer to 5-6%. And Wall Street is still expecting that margins will stay between, let's say, 6-7% in the years ahead. So that Wall Street's saying that this is a structural problem and that margins will not revert higher in the years ahead. And this is where it's important to step back. One of the key concepts that Michael Steinhardt called out when he was one of the major hedge fund titans, he wrote a book called No Bull. It's behind me, I think, somewhere over there. And one of his key concepts is look for something with a variant perception where Wall Street expects this and you think they could deliver much better. And so I think this might be a clear example of a variant perception, which is Wall Street's expecting, margins not to really recover. And if you think about what margins could do, and here it is, I'm chatting with AI Ticker Chat, and chat, by the way, is now completely free. And I find, it's kind of amazing that, chat is, you can chat endlessly with artificial intelligence and it's free to use and gives you some really thoughtful answers. So I ask, ignore what management has said. Let's not anchor onto what management said. Do you think the margins are structurally impaired? This including the latest data, the latest results, and it takes a look and it says, look, it appears that the lower margins are not structurally impaired, but are influenced by several temporary and manageable factors. And I agree with this. It's a promotional environment, meaning tougher competition, having a promotional environment to attract consumer traffic. Part of this is due to the cycle where we are. Part of this is shrink levels, managing what I talked about earlier from a society perspective, people stealing from the stores, damage or error. I mean, look, some shrink you can't prevent. There was a tornado. So you can have things like that impact inventories. Another aspect is the sales mix, which is that consumables are picking up relative to the more discretionary, higher margin items and their investment in the store base. But I look at these and broadly, I think retail is, just like AI Ticker Chat's calling out here, a lot of these key aspects that are hurting the company do not strike me as, that permanent impairment. And so going back to, management's, what they've done in terms of margins versus Wall Street, if they're able to deliver, let's say revert 5 years from now, closer to that 8-9%, I think Wall Street analysts would be forced to, raise their expectations. And then you'd also see a reset in the stock. So it would not surprise me if Dollar General starts to bottom from here. That said, there are some real challenges with retail. There are some challenges with Dollar General. They do have a lot of debt. You can see their debt table here. It's about $500 million or more each year that comes due that they have to refinance. This is a question of, do you think interest rates will be higher or lower in the future? The Federal Reserve is expected to cut rates. So maybe these interest rates stay the same. Maybe they go up slightly higher for them. So I look at this and personally, it would not surprise me if Dollar General works out very well from here. And if that AI Ticker Chat hypothetical, predict, feature where it says, hey, maybe 100 to 300%, would not surprise me if that's in the zone of reasonable, if indeed margins start to move higher and if they're able to find a bottoming process. But I do think it is a cutthroat, super tough industry. There's a reason why I put the everything store about Amazon behind me. It's part of the appeal of Dollar General is that a lot of their store base is in this more rural community. And, you're having folks saying, hey, I just need some food, some rice, maybe I'll pick up a pack of Coke, some Pepsi, depending, I'm personally a cherry Coke if I had to do it, channeling the Warren Buffett. But, part of that aspect is that they have an advantage because of that ultra sort of in the woods locations. Whereas Amazon, each year they're investing billions of dollars into their infrastructure. So that way, those smaller purchases become more and more accessible to all consumers. That said, if you're making under $35,000 a year, which 60% of their consumers are, they're not really the prime customers that Amazon's marketing to. So you have that dynamic. And, as an investor, you also want to reflect on what type of consumer do you want to be betting on? Do you want to be betting on, the lower tiers? Will they be growing faster than the higher tiers in terms of the income level? So these are aspects for investors to consider. Personally, Dollar General is not part of my investment journey. That said, I wouldn't be surprised if it works out really well from here. I was reflecting on this recently. I'm more inclined just to focus on things where I could say, hey, I'm very confident that, this business can grow at, let's say, a minimum of 10% over time and pay a fair price versus something like Dollar General right now, which is you're including an element of valuation expansion, an element of margin expansion, and that's what's going to drive the growth over time. I'd rather say, hey, I'm going to align myself with a great company and, it's growing very quickly and I'm paying a fair price and I'm just expecting it to compound over time. That's more my own personal journey that I'm interested in. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning into Unrivaled Investing.